Okay. FAC 3703 is the one that a lot of students struggle with the most and dislike the most. It is made up of many topics that have nothing to do with each other, and I think that's the main problem with it, because we're going to look at things like government grants, employee benefits, earnings per share, leases, what else? Let me have a quick squiz, see what I'm forgetting. Segments and related parties, borrowing costs, segments, related parties. So you can see lots of topics that really are not related to each other in any way, shape or form, isn't it? The two big ones are leases and earnings per share, which we will spend quite a bit of time on. Leases, we're going to spend at least 3 lectures, and earnings per share also 2 to 3, also about 3, which then leaves a lecture each more or less for the others. Related parties I kind of cover when I do segments because it's so small. But what happens in the exam, and this is where I think the students really struggle, is that you get a question, and the question will integrate government grants with employee benefits, with a lease, and maybe even some borrowing costs, all in one question. The required will be one required. It's not many required. It'll be something like prepare the notes for all the items in the question. It won't tell you which notes. You have to know which notes. You have to know what they look like. And then we will find that there are liabilities there in leases, and there might be financial instrument liabilities, right? So financial liabilities. There might be financial liabilities in leases. There are also financial liabilities in borrowing costs, and there could even be some financial liabilities in government grants. And then that will be one note, but it will have all of it in. The profit before tax note will have pieces from here, which will be interest, pieces from there, which will be grant income, pieces from here, which will be rent or interest or whatever it is, and it's all combined, and students get very confused because you get these massive questions. I've seen a question for 70 marks. So now you're sitting in an exam, and it used to be 2 hours. I don't know now if this year will be again 2 hours or 3 hours, but imagine you're sitting in an exam and it's out of 100, and one question is out of 70. It's so hard to keep focused and to keep track of everything and be able to just concentrate through it, isn't it? So a bit of it is exam technique, because really you having to put all this information onto one set of notes, into one set of financials, but actually you're going to do separate workings for each piece, isn't it? And all you're going to do is take that and put it in. So it's just a question of like being methodical and knowing where things go. So in a way, do you remember FAC 2601 was also a bit like that, isn't it? We had to take a whole lot of different things and then put them into one set of financials. So this is a little bit like that. I think trickier maybe sometimes students find, because they don't ask for, they don't say this note, that note, they just say prepare the notes. And then you have to know which notes to do for which scenario. And so, yes, it can be tricky. And leases and earnings per share are especially tricky because there are something like 5 or 6 different types of leases that we're going to look at. There's operating leases, finance leases from the lessor's perspective, the lessee's perspective. There are sale and leasebacks. There are manufacturing and dealer lessors. You have to know which one you're dealing with because they're all different. Earnings per share also, you get basic earnings per share, you get diluted earnings per share, you get all other kinds. You get dividends per share. What's the other kind of earnings per share? There's another one. And you have to be able, there's earnings per share from continuing operations and discontinued operations. So it all, there's lots of moving parts. So that's the difficult part. But we're going to start today with government grants. Government grants is a very standalone topic, which they sometimes link in a bit with leases or with borrowing costs. But what we're going to learn today, you don't need to remember for anything else that we do. Okay. So government grants is the first section of work. And essentially, there are two different types of government grants. Yeah, we get what is defined in the standard as asset-based grants, asset-based government grants, and income-based government grants. And the first step is to understand, do I have an asset-based grant or do I have an income-based grant? Because the accounting for the two is distinctly different. They're not difficult to define because asset-based grants are exactly that. It's assistance to acquire assets. And government would provide assistance to companies to acquire assets for a number of reasons, either to promote employment, yes, or to promote growth in specific areas, or to meet some kind of social need, like building of hospitals or clinics, isn't it? So we have in this country at least two big hospital groups. They would be encouraged by government to set up hospitals and clinics which are private, perhaps in certain rural areas, and they would be given a grant to assist them or help them to do that, right? So asset-based grants is assistance to acquire assets. Income-based grants it's actually a bit of a misnomer because it's really not to do with income. It's more to do with expenses. And income-based grants are to cover expenses, help cover expenses. So I'm still talking about the clinics that's being built in the rural area, and maybe what government will do is it will say that in order for the clinic to run efficiently, you need to have a certain number of doctors and nurses, and that they will assist with salaries for a while. Yeah, so they may say to you, they will assist, they will pay 60% of nurses' salaries or doctors' salaries for the first 3 years or something like that. Yeah, so we have asset-based grants and income-based grants. So that's definition. When can we recognize these grants and how do we recognize these grants? Recognition for the two is quite different because this grant, the asset-based grant, is recognized over the life of the asset. So we will take that grant, whatever it was, R1 million, and if we're going to depreciate that hospital over 5 years, we will recognize that grant over 5 years. Yeah. The income-based grants, the recognition of those are on a matching principle. Matching. So what will happen is that we will match the grant to the salary over the 3 years. You must be careful with this matching. It is not necessarily straight line. If you think about salaries increase with inflation every year, isn't it? So if I'm looking at salaries of nurses, a salary that starts at 100 may go up to 107 or 110, may go up to like 120, isn't it? So the total salary over the 3 years is not 300, it is 330. And so when we apportion the government grant that we've received, we apportion it like that, 100 over 330, 120 or 110 over 330, 120 over 330, and that's how we apportion it. It is matching, it is not even. Yeah? So sometimes it's even, sometimes it's not, but be careful with it, it's not necessarily even. It's matched to the expense. Okay, matched to the expense. So that's recognition. And there's only one more important thing when we're dealing with recognition, and I am going to come back to it later, and that has to do with the recognition criteria in framework, and it has to do with the criteria of probability. Often, I don't know why when I put dots, they like just make my things grow. Then I'll end up with that stupidness. Let me just try and see if I can fix it a bit. Okay, probability. When government grants are given, it is almost always conditional. Because government doesn't just give grants for no reason. Government is giving grants to achieve objectives, isn't it? To achieve clinics in a certain area, to increase employment, to improve the economic conditions in a certain area, whatever it is. So government doesn't just give government grants for no reason. So usually there are objectives and there are conditions attached. So if, let's assume, the condition is that we employ a certain number of doctors, and we know that it's going to be close to impossible to convince doctors to go and live in this rural area that we want them to go live in, right? And we won't be able to get that number of doctors. Then we really shouldn't be recognizing that income at all. Because at some stage, somebody will come and check if we've met the conditions, and if we haven't met the conditions, we have to pay the money back. Yeah. Some of the examples that you'll see are things like low-cost housing. So there was a government grant given to a company that was supposed to build houses, and they got a grant to buy the equipment and machinery they needed to build those houses. But if they don't achieve the objective of building the number of houses that government wants them to build, they have to repay. Sometimes it's all of it, sometimes it's a portion. And really, at the beginning of the government grant, management should be looking at what is the probability that we'll meet the conditions, because if it's not probable that this income can be recognized as income, that we can meet those conditions, we shouldn't recognize it. And if that is the answer, then it just sits on our financial position until it's time to pay it back. None of it goes into P&L. All right, so that's the two different kinds of government grants, and that's the main principle regarding recognition criteria. Let's talk about, let's talk about how we actually do the accounting. So the accounting for government grants. There are two allowed accounting methods for both types of grants. And it's very important that you check the policy that management has selected in the question, because if you get it wrong, you could get zero. Yeah. The two methods of accounting are somewhat similar in both cases. So here's income, here's asset. The two methods that are allowed are to offset the asset. In other words, the journal entry when I receive the grant will be a debit to bank and a credit to PPE. I buy an asset or I build a clinic. It costs 50 million. Government has given me 20 million. I only record an asset of 30. Yeah? What happens in that case is that depreciation is smaller, isn't it? So I'm going to put that example in. So I have an asset which I bought for 50 million. I have a grant for 20 million. And I'll end up depreciating or having an asset of 30 million, which if I'm depreciating, let's say over 5 years, is 6 million per annum in depreciation. Yes? The second allowed alternative is to show this government grant as deferred income. There's your financial liability, deferred income. So these are my two options. offset against the asset or show it as deferred income. Yeah, my two options. If I show it as deferred income, then my asset will be 50 million. I will depreciate over 5 years. Depreciation will be 10 million a year. Agreed? And at the same time, I will also have a deferred income liability. When I receive that money, the entry will be debit bank, credit deferred government grant. Yes? So when I receive the money, I debit bank and I credit deferred government grant, a liability. Income received in advance. And then this liability will also be recognized over the life of the asset, because that's what we said, isn't it, in the beginning? So this liability will also be recognized over the life of the asset, and every year we will recognize a credit of 10 million. No, the liability wasn't 50. That wasn't very clever. It was only... What was the grant? 20 million. 2 million. No, not 2 million. Sorry. 4 million. 5 years. So, in this case, I will have an asset of 50 million, full 50. It gets depreciated over 5 years, 10 million depreciation. But then I have a deferred government grant, a liability, which I will amortize or recognize the income over 5 years. So I will recognize 4 million a year. And you can see that the net effect of this and this is the same as that, isn't it? So all it is, this policy, is it's not affecting profit. It just affects presentation. Do you agree? Because in my P&L, if I've chosen the offset method, I will have one item. It will just say depreciation 6. If I've chosen the deferred government grant method, the deferred liability method, I will have 2 items. I will have depreciation 10, and I will have the government grant income 4. Net 6. On the face of my statement of financial position, in this case, I have one item, PPE, in this case at the end of the year or at the beginning, 30. Yeah, at the beginning of the year, 30 million. In this instance, I have 2 items, one asset of 50, and then a deferred liability or deferred government grant liability of 20. You know that liabilities, especially financial liabilities, are horrible because we have to split non-current and current, isn't it? So this deferred government grant liability, some of it sits as non-current. So if I had a liability at the end of the year of 16, 4 would sit as current, the other 12 would sit as non-current. Yeah? So that's your allowed accounting methods. You always have to look to see what is the policy that they want or that they've chosen. Management can choose which one they want to apply, which is the policy that they've chosen, and once they've chosen a policy, then the accounting looks different, but the effect is the same. Okay, when we have income grants, the rule is the same. It's the same things that are allowed. We can offset or we can show separately. We can offset or we can show separately. So if you remember the income grants, they're usually to cover expenses. So if I take that income grant for the clinics and I decide that I'm going to use the offset method, I will show my salary expense at the lower amount. I won't show the total salary that I paid. I will show it net of the piece that the government helped me pay. If I choose separate, I will show the total salary and I will show the income that I got from government as separate. Seems easy enough? Okay, seems easy enough. Let's see. In your study guides, there is right at the beginning, I think it's like the 3rd or 4th page. I can actually see what page it is because I copied the page. Page 12. And I just want you to do the calculations for me for each of these, just so you can practice. So you'll see that there are 4 grants on this page. Grant 1 is an asset grant, asset-based grant, and they're deducting it from the carrying amount of the asset. So that's the policy they've chosen. Grant 2 is an asset-based grant, but it's recognized as deferred income. Yeah? So it's going to be shown as a deferred government grant liability, and my asset will be whole. Then grant 3 is an income-based grant, which they're going to deduct from the expense. So you're going to have to see what matches and work out what the expense item will be. And then grant 4 is an income-based grant, which will be shown as other income. So for this one, I want to see 2 numbers. I want to see what will be the expense amount and what is the income amount. Okay, let's have a look. May I? You've had a chance to look at them? Okay. Okay, so the first one was a asset grant, and we were going to offset, right? 1 January 08, we bought an asset for 450. Put the 08 in. And we received a grant of 120, which means that we were carrying the asset at 330. Agreed? It was going to be depreciated over 10 years, straight line. So 33, which means beginning of year, the balance was 297. And then 33 again, end of year, the balance on the asset would have been 264. Agree? So in my PPE note, this is what my PPE note would look like. Beginning of year, it would have a carrying amount of 297, being a cost of 330 and accumulated depreciation of 33. End of year would have a balance of 264, and there would be depreciation for the year of 33. I'm going to come back to the repayment. All right. Then the second government grant was a separate one. We bought an asset of 5 million and we received a government grant of 2 million. Like that, isn't it? Let me actually put zeros in. So we bought an asset of 5 million and we received a government grant of 2 million. Asset, liability. Yeah, deferred government grant, asset. Both of them were going to be recognized over the life of the asset, which was 20 years. So for year 1, 250 of depreciation and 100 to be recognized of deferred government grant, leaving us on 1900 and 4750 at beginning of year. And then again for the current year, another 250 and a 100 on that side, leaving us with 1800 and 4.5 million assets. Yeah? So that's number 2. Number 3. Number 3 was an income grant to cover the salary of 2 supervisors. Each supervisor was going to earn, 3 supervisors. Am I right? 3. 3 supervisors. Each one was going to earn 150,000 rand. So that means it was going to be 450. But then they said to you that in year 2, the salary was going to increase by 6%. So that became 477. So then it becomes 927. And now I've got a grant of 100 to match against that 977, isn't it? So I have 100 that must match those two in proportion. So 450 divided by 927 times 100 gives me 87.379, and then 477 divided by 927 times 100 gives me 92,621. Now it's red. Okay, so when we recognize that one in year one, we would recognize as income 87,379. The remaining 92,621 would stay on the statement of financial position as deferred government grant income, and it would all be current because it would all go into the next year. In year two, the 92,621 would come into my P&L as income, or it would be offset depending on what they've chosen. I think that one was offset. Offset. We would reduce the salary. The salary that we would show would be the net of these two numbers, that minus that. Yeah, and in the second year also, and then we would have a zero balance. Okay, and then the fourth one was 5 employees this time. They were going to earn 75 each. And so that works out to 375. Then that was also going to increase by 6%, but this time the condition was that they needed to be employed for 3 years. So all I do is I increase 6. Yeah, it's inflation. So the total is 119385. I need to spread income of 100 again over those two numbers. Sorry, over there it wasn't 100. That doesn't even add up. 180. Yeah, this one was 100. That one was 180. Okay. So I need to spread it, and I just proportion it. So 375 divided by 1193.85 times 100, and I just proportion it like that. And as I proportion, I get 31,411, 33,296, and 35,293. So in year one, in this case, in my P&L, I'm going to show 31,411 as other income, and I'm going to show 375 as salaries. Yes, because they've elected to show it separate. In my statement of financial position, I'm going to have the remaining bits, but I'm going to have this one as current because I'm going to recognize it in P&L next year, and this one as non-current because it's only going to be recognized in P&L 2 years later. Yeah? So if you were I don't know. Sometimes you think it's easier to just show things separate, but I think in this case it's more disclosure and more work to show it separate, isn't it? However, you need to always check what do they say in the question, how do they want you to show it, so that you can show it properly. Yeah? Okay. Let's talk about repayments, because in this instance we had a repayment over here, which happened at this date, isn't it? Beginning of year. And we also had a repayment. Was it number 3 that was a repayment, or number 4? Number 4. And I think it was also at this period, here, after 1 year. Or was it after 2? After 1 year. Okay, so let's talk about the rules for repayment. The rules for repayment. Do you remember, which of you haven't done FAC 3702? Just Ashley. You also haven't 3702. Also not. Okay. For the rest of you that have done 3702, do you remember what we had to do when we reversed impairments? We had to go back and say, what would it look like if it had never been done in the first place? Do you remember that? It's the same for government grants. Okay, so how do we deal with a repayment of a government grant? And a repayment of a government grant, again, we're going to look at what do we do when we have asset-based grants and what do we do when we have income-based grants. Okay, so with asset-based grants, the rule is get the balance must be adjusted to what it would have been at the lower government grant amount. So, I had that example that I made up. It was something along the lines of 50 million and what was it? It was 20, hey, the government grant, and I was left with 30, and then I was depreciating 6 a year, wasn't it? Something like that. 6 getting me down to 24 and 6 getting me down to 18. Let's assume that that was the number. Okay, so let's assume that we had bought an asset, PPE of 50. There was a government grant of 20, which left me with a carrying amount of 30. I depreciated, and then I had a balance at beginning of the year of 24, and I depreciated again, and I had a balance at end of year. I had a balance at end of year of 18. Yeah? Okay. Now, let's assume, as is in this case, that at this date, beginning of year, I had to repay some of that grant. Yeah? And let's assume that I had to repay half, just to make the numbers easier to do. Okay? What I need to do is I need to redo the calc to see what the balance would have been if I had only recognized 10 instead of 20. What this is a change in estimate. 3701, some of you maybe haven't done it yet. In 3701, we address how we account for changes in estimate, isn't it? And we say management makes certain estimates, and then when that changes, we need to make adjustments. This is a change in estimate. Management estimated or judged at the beginning that they would be able to meet the conditions of the grant, and therefore they took the whole 20. But they should have, or they made a mistake in judgment, and then it turned out that they couldn't meet all the requirements of the grant, and now they have to pay back half. So we have to go and see what would the balance have been if we only had half. So if I do that calc, it would have been 50 and 10, which would have been 40. Do you agree? And then I would have depreciated 8 and 8, which would have left me at end of year or at beginning of year, wherever we are. It would have left me on, is it 14? Huh? 12? 14? 24? 24? Doesn't sound right to me. Oh, you're right. Okay, which leaves me on 24. Okay. So, at the moment I'm sitting on 18, but I have to make this repayment and the balance should be 24. Let's look at what's going to happen when I do a repayment. Do you remember what happened when I received the grant? The entry was debit bank credit, PPE in that case, right? When I do the repayment, the entry is the opposite. So the entry now is going to be debit PPE or deferred government grant, depending what I've chosen. Credit bank. That's going to be my entry. So, if I start with this balance of 18, I'm going to have a repayment. And the repayment is 10. So I'm going to land on 28. Yeah? The repayment makes my asset bigger. It's a really funny thing because you're thinking, what? It's bad, but my asset's getting bigger. But that's what it is, isn't it? It's the opposite of what we did before. The repayment's making my asset bigger. And now that I've put the repayment in, I now need to put my adjustment in because, look, I've under-depreciated, isn't it? And I now must put an adjustment in of 4 to get me to a balance of 24. This adjustment is a change in estimate. Do you remember changes in estimates? That's what it is. Why is it a change in estimate? Because look, my balance on my asset was incorrect and I under depreciated for 2 years by 2. In that year it should have been 8, it was 6. In that year it should have been 8, it was 6. I under depreciated by 4. I'm correcting it. There's my adjustment of 4. Yeah. So that's what we do when we have a repayment of an asset. We must calculate what the balance would have been if we had only accounted for or recognized the lower amount. And it doesn't matter, I've given you the example where it's an asset, but if the example is a deferred, it's the same, isn't it? We still would make the adjustment on the deferred. On the deferred, the adjustment would be deferred income that was over-recognized. Yeah, we recognized too much deferred income, and now we have to adjust. All right, so that's what we do when we have an asset. You have to go back. So now if I go back here, this one had a repayment, hey? I have to go redo this calc with the lower amount. Yeah? Then I have to put the repayment in and see what my adjustment needs to be. So that's what you're going to need to go and do. I need you to go back to number 1 to do that. But before you do, I just want to show you what you do with the repayment on an income grant. And then you can go do 1 and 4, the repayments. On an income grant, the repayment rule is completely different. So on the income grant, the rule is the following. If there is a balance on SFP, use it. Then the rest comes from P&L. So if I go back to the example here, if let's assume at the end of this year I had to pay back, yeah, and let's assume I had to pay back 100. I have 92, which is still sitting in statement of financial position, isn't it? I would take the 92 out of statement financial position to pay it, and the rest would have to come out of P&L. So my journal entry, there's my journal entries for the repayment. Debit, something, credit, bank. My journal entry would be debit, statement of financial position. If there's enough there, it will all come from there. And then the credit would go to bank. But if there isn't enough, debit of statement financial position for whatever you can, then debit P&L with the rest, then credit bank. Yeah? All right. So I want you to, so those are the rules for a repayment. If it's an asset, the balance must be adjusted to what it would have been if it's income. If there's an amount on the financial position, use that first and then use P&L to make your repayment. So that's what I want you to go do back here. Number 1 and number 4 both had repayments. The repayments happened at beginning of year in both those cases. I need you to go and work out what the adjustment is at that date. And to do that, you're going to need to do recalcs, some recalcs.